what happens is that the cumulated fund, as Niamu explained, it's always being turned around. It's being invested. So therefore, it is paid as a lump sum to that person. If the person attains the retirement age and comes to SNET asking for that funds, it is paid in a lump sum with the current interest rate to the fellow, because the fellow did not meet the required number of years that is supposed to contribute. So it's
Thank you
paid
very much.
with the current
Okay.
interest rate. Thank
All
you.
right. Thank you very much. So, there are a lot of concern. All right. So, Dr. Samuel Nim has quite a number of questions. He says, thank you for the insightful presentation. He's noticed that it appears that contributions deducted at source, and I'm sure he's talking about the Controller Accountant General Department, always lags by 3 to 4 months before they are paid to fund managers. So, any reason for this? And also, how can it be corrected in good time? For Tier 2, for example, the latter part of 2024 contributions are yet to be paid. Does NPRA know about this, and are there any efforts to address this speedily to reduce the opportunity cost to contributions? He's also asking that, given how low pension payments are in this country, are there any plans to increase the 35% cap to specifically allow more Tier 3 contributions?
Okay, so maybe I'll work backwards to the issue of default. So with the 35%, so maybe just to give clarity, there's actually no cap on how much you can contribute to the Tier 3. Why we say 35% is because that is what the taxman has given in terms of pre-tax contribution, meaning that you can make contribution or you can make deductions from the salary before taxes applied to the remainder. And so for the purposes of pensions and with respect to Act 766 and the Income Tax Act, it's capped at 35% for both employer-employee contributions for a specific employee. But it does not prevent you from doing contributions post-tax. However, that has come up severally, and I cannot authoritatively say, but I know it's a discussion in the corridors of power on whether those decisions should be made. And the discussions are being held between of course, the employers, employees, and the policymakers as to what is the most reasonable route to take. With the initial question, yes, regulations 102 to 109 of our LI 1990, the Occupational and Personal Pension General Regulations, it states that the trustees are required to report issues of default to the authority, and the authority has a mandate to follow up. And also to point out that where there's a default, the default accrues a surcharge. I'm sure you can agree, collecting money from government is not an easy task because of the many financial obligations government has. But I guarantee you that the trustees indeed write to us. The authority and the trustees also write to Controller, they write to Ministry of Finance. Fortunately, because we are an institution, the Ministry of Finance, there's that also direct communication on these matters. The authority, once we receive the notice that there's a default, the authority also has a mandate to follow up with Controller and government. A lot of these things would come with certain arrangements to be made for the monies to be paid over time. And indeed, because of the surcharge implication, it also places that obligation on government as it does on every other employer. And the intention for that surcharge, of course, is to take care of opportunity costs in terms of lost investment income, and also, of course, to serve as a deterrent from further default. Thank you.
All right. Thank you very much, Niamu. So, Dr. Med Ananefrimpong is asking, first one, what factors and considerations are informing the push to move the pension sector from Ministry of Employment, Jobs and Labor Relations to Ministry of Finance? Number two, SNIT manages the Tier 1 pension funds of workers. This essentially presumes the funds of SNIT belong to workers. However, the president selects and appoints the chairman of the board of SNIT, in addition to the director general and other directors of SNIT. This arrangement essentially places SNIT under the control of government. Is it not time to reform the corporate governance structure of SNIT to allow workers to nominate the chairman of the board and also allow the board to recruit the director general of SNIT? And 3, I'll tie in with someone other person's question. It says the DDEP exposed the grave challenges of mandating that 70%, over 70% of pension funds should be invested in government securities. Since then, there have been some revisions in the position of NPRA. What is the current position of NPRA on investment of pension funds in terms of percentage allocations? And I'm tying in this with another question from Dr. Samuelini, which asks, are all 3 tiers invested in the same form of investment, such as government bonds?
No, this one,
Should I go over one?
You hip. Okay, so the first question, I'm afraid to say that maybe I shouldn't have even mentioned it here, but I mean, it was meant for structure and policy reasons in terms of MELA to Ministry of Finance. But of course, the decision is quite above me in terms of what truly led to that. But our understanding is that it's for policy and structural reasons. Second question that has to do with SNIT and its structure and whether it should not be reformed so that now the board can now be appointing the director general. I think I'll take this more as a comment than a question. And yes, there are a lot of considerations around the reformation of SNIT. And yes, NPRA is quite on top of that matter. And we are currently in the process of considering certain amendments in our act. It's taking quite a while. It's not easy to change provisions in your act. This issue has been brought up and I'm sure would be considered. And as a comment from this meeting, I've also taken note of it and we'll submit it as part of our core report to management on the outcome of this presentation. The third question has to do with DDP, Doc, if I'm right.
Yes, so it has to do with the DDP
Yeah,
posing
and then
grave challenges since pension funds are mandated to
invest
invest
them.
about
Okay.
70% into government bonds.
Okay.
And
And
then
then what
what
has
are
been
the
done so far?
investments? Yes, what has been
Exactly.
done in terms of
Okay.
revisions?
Okay. Yes. So I think there was even an extension where we were talking about whether all 3 tiers are invested in all the same asset classes.
Yes.
So all 3 tiers are not necessarily invested in the same asset classes. Tiers 2 and Tier 3 private pension schemes or privately managed pension schemes, let me put it rightly. They are not private pension schemes, they are privately managed pension schemes, as opposed to SNIT, like has rightly been described, is publicly managed by public parastatal, SNIT. And SNIT has been in existence prior to the operations of Act 766 or coming to force of Act 766. And I'm sure we are all aware that SNIT is deeply invested in real estate and deeply invested in a lot of the banks. I think in almost every bank, SNIT has a significant stake. And so it's quite impossible to put SNIT and the Tiers 2 and Tier 3 schemes in the same jacket. However, there's a mandate on the authority to institute investment guidelines, which the authority has done. And also to add that indeed, SNIT invest in similar assets as Tiers 2 and Tier 3. However, because of their prior investments, their investment asset allocation would not look quite the same as what we have under Tier 2, Tier 3. In terms of the DDP and the 70%, there's this notion that I keep on hearing from presentation to presentation, fora to fora. The asset allocation limit in our guidelines, just as I've mentioned, our asset allocation limits. What that means is that what we've instituted in our guidelines is saying that you cannot invest beyond. Indeed, because of the distribution or the asset allocation limits on the other asset classes, it is actually possible for you to invest in other asset classes without investing even a CD with government. And so it means just as you have 70, it's actually 75%. You have 75 asset allocation limit for government. You realize that there are asset allocation limits for the other asset classes, be it bank securities, which are issuances by the banks, fixed deposits and the like, or equities that is listed, ordinary shares and preference shares, or corporate debt instruments. We are talking about cumulative preference shares. We are talking about corporate debt instruments in terms of corporate bonds, et cetera, et cetera. All of them have their asset allocation limits. If you added all those asset allocation limits, you realize that it quite exceeds 300%. And so that invariably tells you that we are not limiting, or we are not restricting or forcing or pushing a pension scheme to do a specific percentage. It is rather to cap them, to prevent them from doing beyond that limit. And I think that answers all the questions, I believe.
Thank you. And then as a follow-up, is there a benchmark investment return for the pension funds, the fund managers?
Okay, yes. As it stands now, no. I would say no, but yes, because there's in practice, there's a benchmark. The benchmark will definitely be doing better than what government would offer. But there's no standing benchmark, because in practice, investment practitioners will tell you that you do not promise returns. You do not promise returns as an investor. An issuer can promise you returns because they are borrowing your money. But as an investor, especially because you are investing in varied investments and we don't have control over all of them, the best we can do is to do assessment, analysis, look at history, and make sure that we have structured our portfolio in order to reduce the potential loss. Beyond that, we can only hope for the best and continue to do analysis and monitor the pension schemes investments so closely that we ensure that where there are issues, we address them before they compound. And you realize that even with the DDEP, the pension schemes were given a unique offer. Of course, Labour was strongly involved in those negotiations to ensure that even though there were haircuts and head cuts, pension funds got a deal sweetener in terms of what we call the warrants. Thank you.
Thank you very much. So Dr. Masaud Mohammed wants to find out about Tier 2 and then partial withdrawal options for Tier 2.
Partial withdrawal options for Tier 2. So Tier 2 in design is similar to Tier 1. You actually cannot do partial withdrawal, save meeting certain withdrawal conditions. So the conditions for withdrawal for Tier 2 are, of course, retirement at 60. If you are going to go on early retirement between 55 years and 60 on Tier 1, then you can then also apply for a Tier 2, because invariably you'll be on retirement, which is what the requirement is. Then there's a possibility for you to draw down your Tier 2 when you are 50 years and are unemployed. And so in practice, what we have as a process is that you go register with the Labor Department. According to labor law, it says that for you to be declared as unemployed, you should have registered with the Labor Office, and the Labor Office is declaring you unemployed. Of course, elsewhere, they would have been sharing job opportunities with you for you to be re-employed. But we are only using that process to certify that you're unemployed. So there are certain documents we'll look at. And then based on that, NPRA would certify that you're unemployed on the back of Labor Department's certification, and then give direction for the Tier 2 trustee to pay you. You have to be 50 years first and then be unemployed. Then there's... There's for those who are experts. I doubt that we would have that, but we'll have a few. I've met some foreigners in our hospitals here. I don't know if they are part of the Ghana Medical Association, and I don't know that is relevant. But for those of you who are also employers running your own hospitals, expatriate employees, the law mandates that expatriate employees' contributions must be made on their behalf. And when they are emigrating from the country permanently, they will have to go through a process where they get certification from NPRA and can repatriate their pension benefits from their pension scheme, irrespective of their age, for as long as they can prove that they are permanently emigrating from Ghana. Of course, the most unfortunate and undesired one would be death, where you meet your unfortunate demise. Then it means that your survivors would then enjoy the pensions as you have nominated and distributed in your enrollment forms. Thank you.
All right, thank you very much, Niamu. There are more questions, a lot. So I'm putting a number together, but they are all pointing towards the same thing. Dr.
Okay.
Dent Richard Salome says, per section 64, subsection 1 of the Pensions Act 2008 at 766, it says, if a contribution is not paid within the specified period, a sum equal to 3% per month of the contribution payable shall be added to the contribution as a penalty. So there's the preamble. How has NPRA worked to enforce this when it comes to government of Ghana, especially when government is always in arrears, and NPRA seems to enforce this well with private entities? And he says, if not, is NPRA not aiding government to make workers lose money in real time?
Okay, I think I earlier touched on this matter. I've also emphasized that, yes, indeed, or in agreement that indeed it's not an easy thing dealing with government as an employer. However, there's always records to prove or to show what is owed. And indeed, the trustees have the mandate to both issue a demand on government and then communicate the default to NPRA. And NPRA is also supposed to add its voice and follow up through the corridors of power to enforce that government does what is appropriate. In the past, what I know, there have been negotiations where this default or arrears, including the surcharge, have been converted into government bonds. Of course, with DDP, that is not favorable to the schemes, perhaps maybe in the future where things are better. And I know currently, once there's a default, we have that negotiation and make sure that a significant portion, if not all, is paid. I know currently government has attempted to reduce its default period of default to 4 months, and we are working to reduce it to the point where government pays on time. And so it's a slow process, but yes, we are getting there. And it is not lost on us at all. We are following up and we are very aware of the surcharge and ensuring that the surcharge is paid so that workers are adequately compensated for the delayed payment. Thank you.
Thank you very much. All right, so Dr. Aisha Yakubu is asking, I'm working at an institution and just registered for the scheme 2 months ago, to which the institution has started to make the monthly payments. I shared the funds to 3 children of mine. And the question is, can I make payments into my scheme as well, aside the one the institution is paying? And also, can I make changes to my next of kin in the future? Thank you.
Okay, so this is about distribution of contributions and whether you can make additional. So if we are talking about tier 2, no, tier 2 has a fixed rate of contribution. Perhaps if you were talking about tier 3, and then with tier 3, then you have the option to make additional contributions. But I must add that it should be where it is for a personal pension scheme. So if you want to do any further contributions, then you should seek to participate in what we call a personal pension scheme, where you be contributing voluntarily On your own, you'd have decided where you want to contribute, and you have the option to contribute as much as you want to contribute. And for that scheme as well, in terms of your participation, you could also do the same nominations as you've done for the current scheme to which you are speaking. Um, Doc, there was a second part of this question. I think I skipped my
It's
mind.
about changing the next of kin, making changes
Yes,
for next of kin.
yes. So we try not to mix the two. Legally, next of kin means something quite different from what we have in the pension space. What we have in the pension scheme is what we call the nominated beneficiaries. So we are talking. If you are talking about your beneficiaries, yes, you can update it, you can change it for as long as you are running the scheme or you're participating in the scheme. You have the option to make those changes and amendments. In fact, you are encouraged to ensure that whatever nominations you have done are up to date.
Thank you very much. Dr. Abigail Nyako is asking, so 11% goes into monthly pension, irrespective of how long a person lives, and only 4% goes into the lump sum. If that is what it is, then is it really beneficial to the worker?
So you are making 18.5 mandatory contributions, employer-employee. 13.5 is paid to SNIT. 5% is paid to Tier 2. SNIT seats 2.5 to the National Health Insurance Scheme, where the premium for renewing your national health is waived. 11% is used to fund your Tier 1 pension benefit. So indeed, like I mentioned, SNIT is paying based on a formula. It should be SNIT SNIT is the entity that would actually have the obligation to ensure that whatever the outcome of the formula is, they're able to pay. And so the sufficiency of contributions is, to put it very plainly, actually SNIT's headache. I think the interest would be what is accumulating for you under Tier 2. And it would interest you to know that the Tier 2 schemes, even though they came into being just 16 years ago, are actually growing so quickly. They are matching shoulders with the Tier 1 scheme in terms of how much assets they have. And so, yes, I agree that 11% is quite significant in terms of the 5% accumulated for Tier 2 being used to pay lump sum benefits. But we also must know that or appreciate, like my colleague said, SNIT is not paying you a lump sum benefit. They are paying you monthly pensions, and they are enjoined to pay you monthly pensions for as long as you are alive. So if you go beyond 100, SNIT continues to pay you. And we also must be aware that SNIT increases pensions annually. So 31st December of each year, SNIT per law is required to announce what we call the pension increase policy. And the policy is such that SNIT would announce to increase pensions by a certain rate. They do 10% or the average wage inflation, whichever is higher. And so, irrespective of what that formula determines as your monthly pension benefit when you go on retirement, on an annual basis, that amount actually increases. So you can see SNIT's obligation is quite significant. Thank you.
All right, thank you very much, Niamu. So, Dr. Segbefia, who had moved from Ghana Health to Ghana Armed Forces, is asking whether the funds that she had in the Tier 2, is it going to continue to accrue interest if she doesn't contribute anymore?
Yes, please. It will continue to accrue interest. So the requirement under the regulations is that the trustees, once they are made aware that Dr. Segbefia is no more contributing actively or participating actively in the Tier 2, they are supposed to put it on a preservation account. And we consequently receive reports specifically on preservation accounts. That's accounts that have been, for which contributors are not actively contributing. And she can also monitor the growth of her benefits. For as long as her funds remain with the Tier 2, she's a member and she can demand for benefit statements, and she should engage with the operator of the scheme and ensure that She's regularized her account, also to have access to their web portal. Or every pension scheme now has a web portal, so that she can also follow the growth of her pensions through that portal. Thank you.
All right, thank you very much. Now, a number of people want to know how soon after retirement do SNIT payments start, and also they want you clarification on how long are they going to continue receiving the monthly SNIT stipends.
Okay, so just to rehash, I think I just gave, I've said it, I think responded to one of the questions, but SNIT benefits actually start immediately you go on retirement. And what SNIT usually would do is that they would notify your employer, because the employer has a monthly engagement with them through the contribution schedule, submission, and then payment to the respective bank of SNIT. They would notify the employer that the schedule on this schedule, these, if that is if the employer has not already taken action. Usually 3 months to the time, they would notify the employer that these persons are going to go on retirement and they should come in to process their benefits. And so once that notification gets to the member, if you are on their portal, you get that notification. And if you are registered on their website, you also get a notification in your email. So that 3 months before you go apply, and so that they can process, so that immediately you go on retirement, you get your pension benefits. However, if it happens that you do not meet these early notifications, then once you go on retirement, in a matter of a month, it shouldn't exceed a month, SNIT would have processed your pension benefit. Just to add, usually what happens is that SNIT would require that they will generate your benefit statements. They will require that you authenticate or accept what your benefit statements. Of course, this would mean that you're already following your pension contribution accumulation through your working life, so you're aware what it should be. Vetting your benefit statement gives you the opportunity to address any gaps. And if you are satisfied, then SNIT would now go through the process of processing. Even if, let me just put it, and this is just, this is in certain extreme cases, which usually doesn't happen. Even if they exceed that 1 month, in the second month when SNIT is paying, SNIT would add on the previous month's pension. So you would see on the slip that they would issue you that they would have paid you twice. In terms of the SNIT pension stipend, as you call it, or pension, as my colleague defined it at the very beginning of the presentation, SNIT, per the law, pays you pensions for a guaranteed period of 15 years. Now, that period is relevant because if you meet your unfortunate demise, whatever years are remaining up to the age 75, that is 60 years plus 15, would now be distributed to your nominated beneficiaries. However, if you live beyond 75 years, like I said earlier, if you even if you live up to 100, SNIT will continue to pay you pensions, because the pension SNIT pays has an insurance component to it. It's what we call a life annuity. So SNIT will continue to pay, and they will continue to update it annually based on the annual pension increase policy that SNIT issues at the end of the year. Thank you.
All right, thank you very much. So Dr. Mensah is asking, so for a worker who was formerly contributing to SNIT and is now currently under Cap 30, would that worker benefit from 2 pension sources?
Yes, indeed. If you qualify for pensions under both the Act 766 and Cap 30, whether it is Cap 30 to Act 766 or Act 766 to Cap 30, then you'll be enjoying pension benefits from both sources. There's currently no provision that bars you from that, and I'm aware of persons who are enjoying pensions on both schemes.
Right. Thank you very much. Dr. Kwesi Ankoma is asking, is there room for endowment in the pensions regime in Ghana? And then also, what is superannuation? I know that is referring to superannuation, and which schemes or pension managers offer it?
Okay, so our pension scheme is neither an endowment nor a superannuation. Endowments are usually provided for under the insurance within the insurance industry. So the insurance law gives the insurance companies to be able to create endowment funds as a policy. I know that even the insurance space has moved away from endowment and now issues life insurance policies. So we don't have that in the pension space, and that cannot be created. But you could consider your nominations towards your pensions as some sort of endowment. But of course, the contingent is that you are no more and are not going to enjoy your pensions, and therefore the persons you nominated are now going to enjoy the proceeds of your pensions that have accumulated over your working life. I'm sorry, I think I've missed the second question.
The other one was on the superannuation.
Yes, superannuation. So superannuation is simply a pension scheme. So you'd realize that I mentioned that the universities have something they call the GUSSS, Ghana University Senior Staff Superannuation Scheme. And for those of us who schooled in KNUST and were there when the Brunei Hostel, we call it, was built. The Brunei Hostel is actually an investment of this particular scheme. And this scheme is specifically for the senior staff of the public universities. So the true name of the Brunei Hostel is actually the Goss House. And the famous hall in Tech called Katanga, the boys there named it Brunei. So that's just by way of explanation, but a superannuation is simply a pension scheme. So there are some other countries that call pension superannuation. For example, in Australia, they refer to their pensions as a superannuation.
Thank you very much. So Dr. Gilbert Ankra is asking, if you retired at 2009, how did the redenomination of the cedi affect such a pensioner?
So just to put it very lightly, it will affect the pensioner in the same way it affected anybody who was holding CDs in their accounts. 4 zeros were slashed off, and whatever was due you. And so it will be interesting for you to look at your benefit statements from SNIT. You see that contributions that were done pre redenomination are stated in the old currency, where we had millions of CDs. And post redenomination, you realize that the contributions are as we have it in the current dispensation. So four zeros were slashed off.
All right, thank you. Dr. Joshua Arthur is asking, is there any practical impact of delayed remittance of deductions on pension growth?
Yes. So, like the term I mentioned, I said opportunity costs. So that is an investment term or a finance term. Opportunity cost being that if supposing the money were paid, what you would have gained, it's now become a cost that you have to bear. And it's for that reason that the law under Regulation 102 of the LI 1990 instituted a 3% surcharge. And when I say 3%, 3% is per month. And so if you are looking at simple interest, that's 36% per year, but it is applied on a compounded basis. So compounding means that you are getting well over about 38%. And we are all aware that save some instances in the past, interest rates for any one particular security cannot or usually does not exceed um, or reach those high percentages of 38%. There have been instances in the past, but that is not regular. And so this is just to emphasize that the surcharge is supposed to serve as a bridge between the period of default and when the contributions are actually paid to take care of whatever lost income the particular member would have suffered as a result of the default. Thank you.
Right. Thank you very much. So Dr. Bernard Brew is asking, as a government, where can I make voluntary contributions to SNET? And what is the maximum voluntary contribution? And then to tie into what others are also asking, if For example, you are working for a private employer. Can you choose to make payments to SNIT and on your own? And do you have to pay both tier 1 and tier 2 if you are making the payments?
Okay. So the way the law has designed it, tier 1 and tier 2 are brother and sister. But of course, that is because it's being enforced mandatorily on employers for their employees. However, if you choose to voluntarily contribute to tier 1 or the mandatory schemes, is your choice to contribute to tier 1, and you are encouraged to do tier 2 as well, to give you the complement of the monthly pensions and the lump sum benefit payment. Like I mentioned earlier, SNIT's mandate is to pay monthly pensions, and the tier 2's mandate is to pay the lump sum benefit payment. Of course, we are encouraging to even extend to do tier 3, where you do additional contributions. Now, the benefit to paying SNIT or contributing to tier 1 for those who are not covered under the mandatory scheme, I'll come back to the private employer question. Covered under the mandatory scheme is because SNIT offers that life annuity that I described, where if you are enjoying longevity, then SNIT is mandated to continue to pay you once you have qualified for pensions, meaning that you have met the minimum qualification conditions. So yes, as an independent, self-employed person, as you can contribute to tier 1. You're not required to contribute to tier 2, but you are encouraged to, because then tier 2 complements you with that lump sum. When you get lump sums, it's quite enjoyable, a significant amount at a particular point in time. For the person working with a private employer, if your private employer is already paying tier 1, tier 2, I would suggest that whatever energies, whatever effort you have in terms of further amounts you want to put towards your pensions, I would encourage that you target it towards contributing to tier 3. And you cannot on your own, or you would not, SNIT will not accept on your own. Once they find that you are in their database and you have an employer contributing for you, SNIT would not accept to receive contributions from you as a voluntary or self-employed person or a private individual. And so I would suggest or recommend to you that if you have that intention, then look for a personal pension scheme that matches your objectives and make contributions, your extra contributions there towards your pensions. I must add that there are life insurance companies that offer life annuity products that mimic what SNIT does. In fact, in the normal scheme of things, life insurance companies actually have the mandate to sell life annuity products. And so you do have the opportunity to convert your lump sum and benefits accrued under the tier 2 and tier 3 schemes into a life annuity product. What that means is that a life annuity product, meaning that your lump sum will now be converted into periodic payments. So your choice for a monthly, quarterly, semi-annual, or annual payment would be made once you purchase the annuity product.
Thank you very much. So we are wrapping up. Dr. Ann Intakuji is asking, what do you do when a private employer decides not to pay contributions for employees, although it's deducted monthly? It's been reported to the NPRA, and this has not been resolved after years with no feedback given.
Okay, so this is an interesting matter, because we've dealt with a lot of issues, and maybe just for follow-up sake, I would encourage that Doc, once you can get, I think we'll try and give, like I said, to give our contact details. Our corporate affairs team would share the contact details. You can re-engage me independently, and I can follow up on that matter. If it's been years, then that's quite unfortunate, but I'll be very interested in following up on the matter and then for it to get resolved. Thank you.
Thank you very much. Then Dr. Hamdi Akusi is asking, the event that a privately managed corporate trustee for Tier 3 pensions collapses, what protections are in place for contributors, and through what mechanism would contributors recover their funds?
Okay, so that's a very interesting question that I didn't touch on. So yes, so pension schemes are quite um, um, interestingly separate from any of the entities that are associated with the governance and administration or management of the funds. So I'm talking about the trustees, if it's a master trust schemes, the corporate trustee, the fund management firms, and the custodian. And so even if a bank, which is typically the custodian, goes down, the assets, even if they were sitting with a bank, are protected from I want to use the right word, liquidator, when there's liquidation. And then for the banks, they call them, I think, administrators, is supposed to be protected. So our act gives an express protection for pension funds. And when you look in the Banking Act, there's also protection for pension funds. And so if it was with a custodian, there's that protection. With the trustees, because the law says that the funds or the assets of the pension scheme are to be kept separately from the trustee. It means that even if the trustee is going down, the pension fund should be protected. This is quite similar to what happened with the mutual funds and unit trusts, for whom the fund management firms had gone down. The assets were still preserved because those funds were independent of those fund management firms. It's the same situation with us in the pension space. If a corporate trustee goes down, the corporate trustee goes down alone, the pension scheme is preserved. And the question about accessing it, of course, there's a process for liquidating of an entity. And as part of the reporting requirements of the trustees on their pension scheme, they submit a particular report we call Regulation 58, which details each individual contributor and the benefits accrued to them. And so there's some mirroring of data that we have where the authority can assist to follow up. But like I said, the liquidation process is a process. And so as part of the process, members are supposed to be notified publicly that this is the situation on the ground. And one of the avenues is that the pension scheme would not be liquidated. We would get a different administrator to take responsibility for that pension scheme. And as part of the process, members should be notified of who this administrator is. And this is supposed to be done publicly so that there's clear information in the public and you can access that information and access your funds. So the trustees themselves would have notified you. There's public information that this is happening, and the authority also mirrors the information. So you can always contact the authority to follow up on these benefits. Thank you.
Thank you very
I
much.
see there are more questions coming up.
Yes, and then please forgive us if your question is not read. That's some have already been answered. That is why some questions are not read. Then maybe also maybe Niamu and Rosina and Loretta could help by maybe answering some of the questions directly in the chat box, especially those that have already been answered. Yes, so Dr. Benedict Bequin, there's an important one. He's asking if I'm working for government and also for another private agency, so he's doing locum. Can both pay my SNIT? And what are the advantages or disadvantages of such an arrangement?
Yes, thank you. This is actually an issue I had thought to cover. It sort of skipped my mind because of your unique situations. I know that this locum matter with medical professionals. Yes, so there's a specific provision under the Act in the earlier sections. I quite can't remember the section. If I do, I'll immediately point it out, which says that if you are contributing, if you are employed by multiple employers, SNIT is supposed to look. So what SNIT does is that because the contributions are all made against your social security number, at this particular point, we actually look at the SNIT actually looks at your Ghana card number. What SNIT is going to do is to go consolidate all your contributions and as though one employer was contributing on your behalf. So you have 3, 4, 5 employers. SNIT would receive all contributions for all the 5 employers and would deem it as though it is one employer paying. And so if you were to request for a benefit statement, you see that it is all your salaries that have been consolidated as one, and all the contributions have been consolidated as one as well. If you need further information on breakdowns, you can always contact the nearest SLIT branch office, and they would gladly give you information on the breakdown from their portal. They'll generate that statement for you.
All right. Thank you. Thank you very much. Yes, Niamu is babysitting. So, I mean, we need to end the questions here, but it's been a very insightful question. I think one open comment, Prof. Randolph, I can see your hand is up, so we'll give Prof. Randolph the chance. Then I'll hand
thank you
over
very
to
much.
the chairman to wrap things up.
Yeah, thank you very much. You mentioned that government seeks your view regarding pension policies and decisions into the future. I want to know, what have you advised government on increasing the pension age or increasing the contributions going into the future? Thank you very much.
Okay, Prof, it's like you want to tie my legs and my hands.
In fact, I want to cut off your neck. That's a joke.
Okay, so I would have wished I could have given a straight answer to that question. Unfortunately, these are conversations that are still being had, so I cannot give a definite answer to that. But I can point out to the fact that both matters, in fact, both angles are being looked at to see what is most reasonable, what is workable, and what is most affordable and beneficial to the contributor. And so both matters are being looked at. And of course, apart from NPRA as the advisor, NPRA would have to consolidate or solicit information. So there have been various stakeholders that have
Okay. Thank you very much.
yes, that's thank you, Prof.
All right, thank you very much. So
Okay,
at this point, we would call on our chairman, Dr. Dixon Bandon, to give closing remarks. And then just to know that if you look at the chat box, the website of NPRA, the phone numbers of our excellent speakers are also there. So please let's take them so that we can reach out, Dr. Ann, so that you reach out for follow-up. So yes, we'll give way for chairman to give his closing remarks. Yes. Dr. Bando. I think Dr. Bando may be having some.
So can I be heard now?
Yes, we can hear you.
Great. So thank you, Rosina. Thank you, Niamu, for the quite insightful presentation on pensions. And whilst you're on the subject, I would urge Dan and the team to send the tier 3 forms for GMA, that is the staff fund, out across the various platforms, so that members who are yet to sign up to the tier 3 scheme for GMA can actively do that. Again, for those who would want to make additional top-up contributions to any pension scheme, I would recommend that you do that via the GMA fund. For those of you on Apple, those of you on the Android devices, you can go to the Play Store or the App Store, whichever applies, and download the GMA Oracle app. And you should be able to do monthly or periodic top-ups as and when you do. And again, I would urge all members, as much as practical, to keep an eye on the beneficiary list, because as your life situation changes, it is important that you update the beneficiary list to reflect, so to speak, the current circumstance. Thank you very much, Ni. Thank you very much, Rosina, for the presentation. Thank you very much, Kojo, for being a very gracious host for the whole event. And on behalf of the mother agency, on behalf of ESCO, on behalf of council, thank you very much to all members for being very active participants in today's session. I wish you the best of the week ahead. Thank you and out.
Thank you, Dr. Hilton.
Thank you
We
very
don't take
much.
this for granted. We are so grateful and we appreciate your time.
Thank you very
God
much.
bless you.
Thank you. And on a lighter note, Dr. Bando, GMA Fund, you have to pay Mother GMA some money for the free adverts. On a lighter note. Yes. Thank you all. Have a good evening. Thank you.
The recording will be shared on our various platforms, and interim members could also access the recordings on YouTube channel where it was viewed, part of it. Have a pleasant evening.